Well, good afternoon. On behalf of AGH Wealth Management, welcome to our mid-year outlook, where we share our thoughts and our broker-dealer LPL Financial's thoughts on the year and where we're at midway through. It's been an interesting one for sure. And as we do update our views on the different pillars of investing with the economy, with bonds, and with stocks. And obviously, as the headlines are changing daily, we want to look to specific pillars or trail markers to guide us, and so we hope to offer some guidance today. At the midpoint of this year, we're mindful that it's been an extremely challenging year so far in the United States and around the globe. We're in the midst of this pandemic that continues to impact all of us, our communities, and our economies. Together, we're looking ahead for new ways to face these challenges and how we can prepare now for better times. We've been pretty impressed with what we've seen so far, the resiliency and the accelerated innovation among large and small U.S. businesses, efforts by our national, state, and local governments to support our communities, and most of all, just the dedication and unprecedented cooperation among our frontline health professionals, our medical researchers, and just everyday people to guide us through this health crisis. But it's been an amazing year that we'll remember for a long time. My name is Brian Ginch, and I'm a certified financial planner, portfolio manager here at AGH Wealth Management. I focus on overseeing our firm's personal portfolios and strategies, as well as overseeing our personal financial planning service. At the conclusion of today's presentation, I will make myself available for a short while if you have any additional questions or follow-ups and you'd like to contact. And so make sure that you contact me if you have any questions post the webinar. As well, if you like the slides, you want to see more depth to the slides and to our thoughts and LPL's thoughts. LPL has a full color booklet that we would be glad to provide you upon request. So just let us know. As well, you can email me and I will get that to you. I think they're right now on back order, but as soon as we get them in, we will send those out. So we're going to first take a look at the economy, and then we'll look at the stock market and then the bond market. And then we're going to comment a little bit on the elections, kind of the big, 500-pound gorilla in the room. So we're going to talk about that as well, and discuss how predictive are these elections when you look at the economy and the stock market. So we'll begin again with the economy. Much of the real-time economic data we follow, such as transportation activity, home sales, jobless claims, are showing tangible evidence that the economic activity, while still depressed, has begun to make a comeback. So the U.S. economy entered officially into a recession in March 2020. Per the National Bureau of Economic Research, obviously as a result of the lockdowns and business closures to contain COVID-19. After the GDP contracted by 5% during the first quarter on an annualized basis, Bloomberg had expected the second quarter to be over 34% contraction. In actuality, it came in a few percentage points better than that. But still an extremely harsh second quarter for GDP contraction. With that, though, we do see a strong second half rebound in economic growth as more of the economy continues to open, and the recession may end up as one of the shortest recessions ever. However, the resulting recovery is unlikely to be strong enough to get economic activity back to 2019 levels by the end of this year. So we're going to look for probably a few years before we really see a full recovery from the economic contraction that we've seen. But I mean, this was a fast, deep cutting, accelerated recession, and you know, a lot of the metrics that we use to measure when we're in a recession, they come so infrequently that we really had to look at other metrics to say, hey, we're there before we even had some of the data that would confirm it. And really, probably if I would talk about the main source of data that was just extremely impressive and it was hard to see is just the jobless claims, the initial jobless claims. And so just as a case in point, initial jobless claims is a weekly number. It measures how many people are initially filing for unemployment. In a good economy, when we're going to have a natural churn of people being laid off and filing for unemployment, in a good economy, and really what it looked like in early February and in January of this year, jobless claims typically run between 250 and 275,000 on average per week of people filing for initial unemployment. If you think back, for those of you who remember well, 2008, 2009, and the financial crisis, the worst weekly reading we got back then was somewhere around the 665,000 people who filed for initial jobless claims in one given week. The worst we've seen since we've been doing jobless claims data was in 1987, and the reading was, I think, 695,000 people filed for initial jobless claims. So it gives you a barometer of where the spread can run. The first reading we got in March, after we started shutting the economy down, was 3.3 or so million filings for initial unemployment. The next week was 6.6 million. If you can remember, these websites, these places you can file for claims were being overrun with people trying to get on them, and they were just shutting down. So literally, it was probably a worse number if the people could have filed for initial claims the week before. But in 2-week period, we hit 10 million people filing for initial jobless claims. That is a daunting number. And that's just the significance of how fast this hit us versus previous recessions. Now, since then, the good news, if we can look for it, is that since the 16 weeks after we had that spike, while we still kept getting high weekly initial claim numbers, it continued to decrease, and it hasn't been till these last 2 weeks where we've seen it level off or slightly increase. And so we're seeing a kind of a stabilization of at about 1 to 1.2 million people filing for initial jobless claims. But that is a large number. And if you think about in April, if you look at the jobs, the unemployment numbers, we lost over 20 million jobs in April. In the entire if you look at the 2 weeks, or I'm sorry, the 2 months, including March, over 22 million. In the entirety of the financial crisis, we lost between 8 and 9 million jobs. So the magnitude of this cut that we self-inflicted, and obviously we were dealing with a pandemic, but it was massive, and so we had everything had a massive reaction to it. So the good news, again, if you look at May and June, we've recovered about 7.5 million recovered jobs. So look at it another way, we've almost recovered as many jobs as we lost in 2 months that we lost in the 2008 crisis. So that's where, when we're looking at how this is going to swing, a lot of economists are thinking this might be the fastest recession that we've ever had. That kind of plays into some of the things we're going to talk about later in this webinar. We're sitting at about 11% unemployment. Again, financial crisis at its worst, it was at 10% unemployment. And then the other thing that we want to look at as we watch people are continually filing for unemployment and for initial claims is we also want to look at continuous claims. How many people are going off of unemployment? And that has shown that the jobs market has actually troughed, and it hasn't necessarily these initial claims haven't just added to the job loss. So we're hoping to continue, if we can continue to see the economy open. Obviously, in certain areas of our nation, certain aspects of the economy are still shutting down or are limited in scope. But as we continue to look forward to the reopening of our economy, I think we are going to see some massive quarterly positive GDP reports that we've never seen before, but they're not going to make up for the fact that we have contracted heavily this year in our economy. So the trajectory of the economic rebound remains uncertain, but based on the depth of the contraction and the multi-staged recovery, really LPL is looking at their GDP forecast calling for a sizable contraction in 2020, obviously. Second half growth headwinds that may linger well into 2021, which would suggest more of like a swoosh-shaped recovery. So we have a lot of, if you watch CNBC or you're reading a lot of articles, everyone's talking about what this recovery looks like. Is it a V-shaped recovery? Is it a U-shaped recovery? We think of more of it being a swoosh-shaped recovery, or if you prefer, maybe a check mark. So a quick, sharp decline, a small snapback, and then a gradual recovery over the next 12 to 18 months. And we've already seen pockets of the economy that are showing that there was an initial kickback up and then somewhat of a stall. So we don't think the square root symbol is, we think it's too pessimistic. The U-shape doesn't capture the multiple stages of the recovery, and the V-shape is just too optimistic. So, areas that we're seeing that obviously have a long way to go still in recovering are, areas like hospitality and leisure and travel and energy and financials. So for restaurants, if you look at restaurants are still year over year down 50% of dine-ins, seated diners, still sitting at half, and that is a flat number. That is actually shown that it's started to retract back down a bit since it recovered after March and started recovering in May when a lot of the economy started opening back up. Similarly, if you look at energy, the demand for energy absolutely plummeted. If you look at U.S. travel, so the TSA has daily travelers, you can go online and you can see the daily travel. And on what seemed to be on a normal day, you're going to get between 2.5, 2.7 or so million people traveling per day in the U.S. It got down to a number that was, I can't remember what day it was, but it was under 90,000 people traveled that day. So just a massive halt in air travel. Since then, we've come back up to about 600 to 700,000 people a day, but that has also stalled and shown a little bit of a sign of potential contraction back down. So we are still very hesitant to travel by air, and that is a huge part of energy demand in the U.S. If you look at metro, big city metros, and they're similar thing. They've dropped heavily in March and have stalled in June. If you look at driving activity, so actually Apple has a U.S. map routing request data that you can look at to see how many times people are asking and requesting data. So that's if there's any bright spot, that would be maybe the closest to bright spot. We've seen that cratered to about a 60% of a drop in March, and that has come back almost fully up, but it's continuing to show some weakness at the top, and so it continues to show a little bit of contraction. But we're driving places before we're flying these days, and so that's helping a bit, but we still have this gigantic energy demand issue. And until that issue is resolved, you're going to get certain aspects of our economy that just are not going to be able to recover and push forward. So with the economy, then obviously runs the stock market. So if we turn to the stock market, we've seen stocks already are pricing in a steady economic recovery beyond 2020 that may be supported if we receive breakthrough treatments to end COVID-19. However, the optimism we see reflected in the S&P 500 index now may limit the size of the gains over the rest of the year. Now, it is typical for the stock market to bounce 3 to 4 months prior to a recession ending. So it's kind of hard to judge the behavior of the stock market in what could be the shortest recession we've seen. 2009's recession was about an 18 months of recession. So if we're talking about a third the size or less, then the bounce may not have happened inappropriately. It's the magnitude of the bounce that is a cause for pause in what we're seeing. But if you look at the S&P 500 and you look at where the S&P is up a few percentage points year to date, and you look at that and you say that can't be, that's unhealthy. What you have to do is you got to open the hood and look through the S&P 500 and break apart the different parts of the stock market. So the S&P 500 is a mostly large cap, heavily tilted to the growth side of the stock market, but it is a overall allocated of U.S. stocks. But if you break that apart and you say, look, what's large growth stocks doing? What's large value stocks doing? Tech stocks and small cap and mid cap stocks. And then you look at international. It is not the same story, right? And we've seen that in our portfolios to some people's benefit and to other people's chagrin. We've got large growth stocks that are up over 20% year to date. Large value, however, is down 12%. And that is one of the biggest divergence and bifurcations that we've seen in a long, long time in the stock market. When you have a over 30%, 32% difference in large growth stocks and large value stocks, that is telling us a story. And that story is that this recession is not a normal recession. And we typically say, look, it's always not the normal thing that causes us to go into a recession, but there are signs of when you have a cyclical economic stages that you go through. You got the recession, the recovery, the middle mature, and then the late aging stage, and then back into a recession. You have very well-defined, if you can actually make a well-defined stages in a very multifaceted and very complex economy. You have these stages, and the cycles follow those stages, and there's indicators that help us see when the economy is getting too hot and interest rates are swinging a little too high and wage inflation is going too high up. None of that was the case when we hit February of this year, and so we can't look at this recession and say, well, the behavior of the stock market and the behavior of the bond market in previous recessions gives us good predictive power for what's going on here. There's some of that we can maybe pull from, but by and large, a self-inflicting economic crash is a different type of recession than one where an economy got too heated up. When we've had record low interest rates, 2019 was obviously a pivotal change in the Federal Reserve's interest rate environment, and so there's just a lot of things that are different in this one. Small cap, is down 8%, mid cap's down 7%. All of the international major indexes, are down from 0 down to 9%. So while we look at the S&P and say that may be too high, what the story is saying is there were aspects of this stock market that had absolutely little negative effect. If not, they had a huge positive effect to a quarantined economy. And so you saw a lot of innovative companies and tech companies who really just exploded in earnings. And we saw Amazon's earnings earlier this month, or well, I guess late last month. We've seen Zoom video, we've seen DocuSign, and all these different tech or e-commerce companies that have just thrived through this, and that's why you see the NASDAQ 100 almost reaching 30% positive year-to-date return. On the other side, you've got the financials who are bearing a lot of the brunt of this in their earnings, and with low interest rates on top of that. You've got real estate, energy, and all the things that are on the value side, which are causing this bifurcation. And the hard part in that is that value was typically your defensive stocks that would not fall as much in a recessionary bear market in the past, because they're not typically priced as high. They don't have as high valuations or PE ratios, and so they don't tend to fall as fast and as hard in a recession. Well, this was a recession that attacked one side of the matrix. I mean, it was more complicated than that, but it really just heavily attacked one side in specific areas. And so, it's been really hard for older clients who maybe have stock positions that are more dividend focused or income focused or just defensive in nature focused. It's still been a hard year. So we don't look at the stock markets and their portfolios and say, hey, we're fully recovered, because we're not. There is still a depression of value happening there that we haven't just fully bounced back from. So we don't think it's a V-shaped, even though the S&P looks V-shaped. This is not going to be a V-shaped full market. It's very pocketed right now. So again, our expectations for a gradual economic recovery in the second half of the year are conflicting then with the S&P's rapid ascent over the past 12 months. On one hand, gains appear appropriate based on the likelihood that the recession could be the shortest one ever, aided by massive stimulus response by policymakers and initial progress toward vaccines. And when I say massive, I mean we are talking massive amounts of stimulus happening. The Fed, you have fiscal and you've got the monetary. On the fiscal side, you're looking at close to $3 trillion worth of stimulus through the PPP programs and others. Through the monetary, the Fed policy, they have done a ton of buying treasuries and asset-backed securities and credit bank liquid swaps. And I mean, we're talking probably 2.5 to about 2.5 trillion. One thing that has not, though, has been promised but not delivered to us is the other fixed income side, and we can get into this a little bit more when we talk to the fixed income or the bond side of the market. But there are trillions of dollars that have been promised to the corporate credit, Main Street lending, money markets, munis, commercial paper. There's a lot of money that has been promised and allocated towards, but not delivered to. And so we are a fractional percentage of what has been promised. So some of that stimulus has yet to come in. Could be why we're seeing still some stability in the markets, knowing A, there's probably another stimulus package coming soon before the recess in August, and B, a lot of the money that was promised to us we haven't seen yet. And it's some of the stuff that has really affected the bond side of the market, which we'll get to. So that stimulus has been it's what maybe has helped cause such a sharp increase initially in the stock market early in the second quarter. So then, on the other hand, the risk of a second wave of COVID-19 remains, and particularly some southern and western states have seen increases in infections and hospitalizations. In addition, some of the 20 million jobs lost in March and April, as reported by the Department of Labor, will take a while to come back due to social distancing constraints and the potential for lasting changes in consumer behavior. So, for the areas of the economy where we still have to practice heavy social distancing, it's hard for businesses to become fully, have their full job plate back with them in their companies. And so a lot of that constraining is going to create the pause for a better labor market in the future. The good news behind the COVID cases is the even confirmed cases, which obviously spiked in late May as we got more testing availability, has started to decrease as of the end of June and partly through July. And so on the same side, we've seen on the fatalities, we've seen the fatalities in the U.S., which delayed their spike, but it looks like potentially that they're leveling off. And so, when we think of the stock market is pretty unemotional in that it doesn't care as much how many people die from COVID. That sounds a little morbid and sounds mean, but mother market cares much more about the fact that we would shut down our economy. That's what the market cares about. And so if we see fatality rates spike for a little bit but then come back down, the markets can shrug that off. If the only thing that it's affecting is the fact that we have to wear these things over our faces, or we have to try to stay 6 feet away from each other at the parks and things like that. If it becomes any worse than that, where it becomes more of a shutdown mode or a quarantining mode, that's when we could see the market respond negatively. And so, a lot of questions we've gotten is, why is the market continuing just to go up as cases are rising? Well, cases are rising, but hospitalization rates, which have leveled off, and death rates have leveled off as well. And so that's what the market's looking at. And so there's a lot of uncertainty still. And the uncertainty around these paths suggests that stocks maybe have come too far, too fast. Although some recessions have seen stocks quickly recover bear market losses back in 1980 and 1990, most of the time the journeys back to record highs have taken a year or more, as you can see here in this chart. And so, one of the things I think that, just to go back to the S&P 500, one of the things that it is a concern for us in how high the market's gone, how fast it's gone, is the concern over market breadth. And market breadth means how many companies are responsible for driving the higher market up. And if you look currently, and this is as of end of last week, but the combined weight of the top 5 S&P 500 stocks is the highest it's ever been. So as the and a lot of these, you can think of the FANG stocks, you're going to hit a lot of them in there, but 22 to 23% of the entire S&P 500 makeup is made up of 5 stocks. And so the problem you have when you see something like that is, if those 5 stocks prices decide to contract, the rest of the market could be flat or even growing a bit, but you could still see a correction in the market. However, if those 5 continue to go up, they could continue to drive the prices higher. If they stabilize and the rest of the market catches up to them, you can see again even more strength in that upward move, and that more momentum and a better version of increasing stock prices. And so right now we say the stock market's recovered, but it hasn't been because everything's recovered. And I think I probably kicked that horse too far. But it really is the story of a few making the rest of the party look good. And the reality is we still have a long ways to go. So think about earnings. So earnings is obviously one of the things that we track in the S&P 500. The forecast of how much S&P 500 companies can make depends on then how much we're willing to pay for them, and that's really where the price point gets set. And so the S&P 500 earnings forecast for 2020 to LPL is at $120 to $125 a share. At the midpoint, earnings would drop about 25% from last year's levels of 163, roughly in line with the average historical decline in recession. So the earnings hit we've taken so far has not been unlike other recessions. But this forecast does reflect the severity of the decline in economic activity in March and early April, and then the initial snapback in activity after many states began to reopen again in mid-April. And then the growing headwinds that will constrain the trajectory of the economic recovery. The good news here is we're deep into earnings calls for second quarter, and there's currently an 80% beat rate. So 80% of the companies reported in the S&P 500 have beaten their earnings estimates. And that's just a function of, that's good news. It's better than the alternative. That doesn't bring a ton of optimism though. Most S&P 500 companies, most US stocks, when there's a bad environment economically, it gives them basically the ability to overshoot a drop in earnings. And then they can come in and beat those drops and look like heroes. And so you saw that in 2018 when at the end of the year in 2018 and into 2019, earnings estimates just dropped heavily because of what had happened in the last quarter of 2018. And then everybody beat earnings. And you typically see every year at the beginning of the year, earnings are estimated low and you typically get an earnings beat. But an 80% earnings beat is really an amazing beat, even in that kind of constant behavior and scenario. So, we're hopeful that that's signs that we can continue to see a recovery there, which from a stocks market standpoint, it helps us, dictate how much we would be willing to pay for that and what we could expect returns to be. So the optimistic, on LPL side, at least the optimistic outlook is for the S&P 500 to end at 3450, and their base case is that they would expect it to be at 3250 to 3300, which if any of you have CNBC on right now, can be a little nerve-wracking because right now we're sitting at a little over 3300 in the S&P, and so we've got a lot of uncertainties in the future. Are we too fully priced in, or are we overpriced for the time we're in? A lot of that is going to be dictated by future earnings, future GDP numbers, and how fast we can snap back from this. And so while it looks like we maybe hit this base case scenario too early, the environment in the stock market is much different than it was at the beginning of the year, and obviously we can see some lights at the end of the tunnel, but there's a lot of uncertainty ahead, and not all the stock market has worked together to recover. So there are going to be pockets we believe that can still move forward through another pandemic if we get more increases happen in the fall when school starts. But right now a base case shows that we may not have a ton of room to run from here. So we would expect sideways volatility potentially for the rest of the year, which would cause us to try to find the parts of the market that are being hit harder and can recover better, and we try to move to those parts of the market. But it's going to be a very interesting rest of the year for the stock market, and it's going to be a very interesting rest of the year for the bond market. And so let's just talk a little bit about the bond market. We expect interest rates to remain historically low levels, but the direction may be higher over the rest of 2020. So the year-end base case for the 10-year Treasury for LPL is to end the year between 1 and 1.5%, which would actually be the lowest level to end a year on record if it was realized. However, as of today's levels, that's over double, or that's at least double of what the current 10-year Treasury rate is providing. So that's just a sign of how much the Treasury market in interest rates collapsed interest rates over March and April. Rising yields contribute to bond prices falling and vice versa. It's a kind of bond market 101, right? You have rising interest rates, price of bonds fall. You have lowering rates, prices of bonds rise. So again, if we expect there to be rising rates, we can in the treasuries, we can expect that the treasury prices will fall. It can be offset by credit spreads and tightening and the interest income that most bonds provide. As this chart shows, with the credit spreads of the Barclays Aggregate Bond Index already near the average for the last cycle, and interest income is historically at low levels, we would expect the indexes to return at the best flat over the rest of the year, with some risk of losses if interest rates spike fast. However, it'll take a move above our target range to erase gains from the first half of this year. So let me put that a different way. The bond market has had two very interesting years, 2020 year to date and 2019. If we all remember 2019, Fed Reserve did a pivot and they started lowering rates. And so that lowering rates led to bond prices moving up. At the same time, we were recovering from our 2018 drop in the stock market. So the stock market had a great year and the bond market had a great year. And they both had good years inside of a good economic environment, but they had it for very different reasons. The stock market was not earning as much as it did in 2018. People were just more comfortable buying it in 2019. And the bond market was responding to the Fed lowering rates to substantially low levels, ending 2019 with the thought of, when is the next rate increase going to happen then? How long will the pause be? So then 2020 comes around, and where we think, hey, there's not a lot of money to be made in treasuries, which is true early in the year. When you take a 1.5% treasury and you drop it to almost flat, I mean, I think I saw one day where it was hitting 0.3 or 0.2% was the value of the 10-year treasury. You saw this massive increase in prices, and that was your safe haven investing. That was your, everyone flocking to the dollar and flocking to safe haven investments like the treasury and gold. And the treasury really got the most of that. And so especially once the Fed announced their stimulus, the treasury and the Fed started buying treasuries. You had a good buyer in the market now too. And so, the 10-year treasury, the treasury market year to date has had phenomenal returns, but everything else has not had the same kind of returns. And so you saw investment grade corporates that were still hovering really low. You had short-term paper that looked bad, floating rates looked bad, emerging market debt looked bad. And a lot of those other areas of the bond market where we've been promised stimulus, and even the muni market, we haven't received that stimulus yet, that buying power. And so if you're looking forward in how you allocate your assets, the thing I want to say about treasuries is you cannot expect over the next 3 to 5 years to earn much of anything in the treasury market. You can, however, expect to earn more return in the lower credit facilities like the corporate bond market and the high yield space and the emerging market debt, but that comes with a cost. If we have big market corrections like we got in March, treasuries may not make you a bunch of money, but they are still going to be the best safe haven investment and safe side of the portfolio in those times. And so it's a really hard time right now in the bond market to decide where we want to be. If cases rise and we get a correction in the market, then the treasuries, while they aren't supposed to make us money from here on out, could give us a nice safe haven investment. But if we kind of ho-hum and we begin this slow incline away back from our contracted economy into a positive GDP, then we would expect the other aspects of the fixed income market to perform better. And so there's this really interesting tug and pull or the push and pull from both sides of the market saying, where do we want to be? And it's really predicated on what we think is going to happen for the rest of the year. So our thought is, you want to kind of have a mixture of all. You want to have it, first of all, highly managed and not just buying the breadth of the market. You want to be strategic in how you're and specific in how you're buying. But you also, doesn't mean you want to just disband the thought of having treasuries at all, because they really do end up being the one area that becomes a really good safe haven when the stock market crashes, and if the economy would come into another recessionary environment, or we just stay in recession and we don't get out of it. So, you know, you got a base and bull case in the economy, treasuries are bad. Got a bear case in the economy, treasuries are good. And so that's where we just have to figure out, you know, what's appropriate, and it's based off time horizon and all the other aspects of your financial plan, and how you need that money in the future, and what kind of volatility you're okay with. Because the Fed's unlikely to hike rates this year for sure, and probably not in 2021. Even if the economic recovery is a little better than the baseline expectations. Persistently low inflation during the last expansion should minimize any Fed concerns that it needs to raise rates preemptively to keep inflation under control. I mean, we all remember the QE programs that happened in 2009 and 10 all the way through. You know, QE 1, 2, 3, Operation Twist, there was quite a few of them. And so we all expected this runaway inflation, and that never came. And so from the Fed standpoint, they don't have to, yes, we are throwing a ton of money onto the market. But the last time we did that, it did not necessarily create runaway inflation. And so they don't have to be aggressive with their interest rate policy making. And they can wait and have a pause. So it's, you know, the last recession, it was the first time we were really introducing these kind of programs. This recession, we've been there, we've seen it, we've seen how it responds. I think we have a smarter Fed because of it. And so, and I think that smarter Fed would say we probably won't be raising rates for a foreseeable future, which would include all the way through 2021. So, but that being the case, you know, you're going to have very little chance of making a bunch of money in treasuries, which is why we say, hey, on the base case scenario, treasuries, don't expect them to be a contribution to the overall portfolio. So to wrap it up, I mean, we're just going to have a couple little slides on the election. Obviously, this election, you know, every election seems important. This election seems like it's got the most at stake, and I'm not saying that not from a partisan standpoint, just from a, you know, we are in the middle of crisis right now. For sure in the U.S. and still in a lot of places globally. You know, the elections are usually a volatile time for the stock market, and so it's important to know. I mean, we have a lot. This is probably the one question I get the most asked is what happens if, and then fill in the blank, and what happens to the market if this person gets in office, and what happens if this happens. So we want to address it a little bit. And what we want to really focus on is historically, you know, with different party affiliations, and then also, you know, what we would expect the moderate voter to do, given different economic and market environments. So this will be one of the most unique elections we have. It's a pandemic, a deep recession, extremely heightened partisanship, mail-in ballot controversies, unpredictable president, and then the oldest presidential candidate ever. And so it's just, this is setting up to be a very interesting next 3 to 6 months. Often asked if stocks perform better under Republican or Democrat. We take a different angle and point out that stocks have tended to do their best when we have a split Congress. We've talked about this before in past webinars that were in election years, but markets tend to like checks and balances to make sure one party doesn't have too much sway. When Republicans have controlled both chambers in Washington, on average, the S&P has gained 13% and GDP has been at 3%. When Democrats have controlled both the House and the Senate, the economy did a little better, GDP up 3.3%, and S&P 500 was a little less at 10% annualized. But when we've had a split Congress, the average S&P 500 gain was noticeably different. And GDP was kind of back to your average of 2.83%, suggesting that markets would potentially prefer split power. Now, there is a lot of things not being said in this graphic, and main being whoever's in the Oval Office during specific economic cycle stages, there's a little bit of a got lucky aspect. Okay, so just because party colors or the colors of this one or the other party were more prominent in Congress or in the Oval Office, doesn't necessarily mean they can lay claim to all the bad or good things that happened in the markets. Okay, so but this is a substantial difference. The split Congress numbers are substantially higher, and what I do think that says is the stock market does tend to like that split Congress because of the accountability that's there, the inability to run up, either side's agenda, which also tends to be running up the budget, and so the market has better predictability of policies, knowing that there can't be massive changes in policy, or there's a lot less likelihood of changes in policy when there's one part of Congress that is on the other side of the aisle. So we think the market likes that accountability. We think it creates more clarity for the market on how policy will affect it long term, which gives it a better way to, understanding of how to price it. So how have stocks performed, and how they performed prior to the election, specifically the 3 months prior to the voting day, has actually delivered a very solid track record of deciding who will be in the White House. The S&P 500 has predicted every presidential election winner since 1984, and 87% of the winners since 1928, with stocks favoring the incumbent party if stocks are higher the 3 months prior to election day. As the chart shows, if stocks sell off ahead of the election, the opposite party has tended to win, and the incumbent party has lost. So actually 20 out of 23 times since 1928. So only minus a few presidents, if the stock market is up from basically right now to election day, it has a very strong track record. Now, we can also say that this might be a very different election. There's been a lot of elections, though, that I think we would all say, and would have said if maybe I was alive back then, that they were very different elections. A lot of things hang on the balance in this one. A lot of things have hung on the balance in previous elections as well. So it's a very interestingly high track record that the S&P has in correlating to then which party resumes office the next December. At the same time, not only, and we don't have the graph here, but at the same time, economically, it makes a difference. So if you look at all the way since 1900, and you look at all the different presidents who have run for re-election, out of the 11, I believe, that ran when there was no recession on voting day, all 11 of those won. And out of the 7 that ran and people voted when they were in recession, 5 of them lost. So you want to kind of look through the numbers and ask why. And I think the easiest answer that I can come up with is people who don't feel like there needs to be change don't vote for change. And really, again, the progressives are going to always vote one way. That's a blanket comment. The Tea Partiers and the harsh red, they're always going to vote. It doesn't really matter who's in office. They're going to vote Biden or Trump. Who really sways these elections are the moderates. And so there's a lot of conversation around, well, how did the moderate group grow this last year? But the moderates tend to be the ones who decide who are in the Oval Office. And these charts, these statistics would somewhat say that, people vote with their pocketbook. If the economy is doing okay, if they have a good job, if their 401k is going up, things feel good. And if it ain't broke, don't fix it. However, if things don't feel good, there's a more apt reason then to change parties to see if the other guys can do it right. So this is going to be interesting because if you were to ask me to try to predict what the next 3 months look like in the stock market, I would tell you I have absolutely no idea. We do have a kind of a high stock market and some wrong reasons behind it, but we also have a market that's shown extreme resilience in certain pockets through all the coronavirus issues, and the things that have really hurt us has only hurt a part of our economy as it pertains to the markets and their earnings ability. So it's not that easy to predict. And at the same time, if you were asked, well, we'll be in a recession when voting, happens in November, I think the answer is it's kind of hard to understand. If this was a normal cycle, we'd say we're probably not going to be out of the recession. But this one came so fast, is really hard to predict. And so these next 3 months are going to be really interesting. And the last thing I'll say as I start showing some of these disclosure slides is, I hear a lot of fear in the markets, and in investors with the markets and what happens if Trump gets reelected, or what happens if Biden gets elected. And I think one of the things that, just since I have a more audience than one person on the phone, I think the way we're looking at this, whoever is in the Oval Office is going to have a very important task ahead of them. And that is going to be to continue to push us out of this pandemic and slingshot us out of the recession that happened early this year, that started early this year and may be still here in 3 to 6 months. Everyone's going to run on their own agendas. They're going to have their own things, their platforms they stand on. At the end of the day, no matter who's in office, they can only do so much damage. No matter if an entire party is represented in Congress in the Oval Office, they can only do so much damage. The pendulum always swings one way and the other. We may experience that, the start of that, this cycle of elections. We may see that in the midterms. But the market has proven resiliency through a lot of it. Trump has had an amazing track record in the stock market, but so did Obama. Obama had a 12% annualized return in the market. Bill Clinton had a 16% annualized return, and Trump had, before the crash, a 13% annualized return. So the markets aren't necessarily moving purely on the fact of policy in Washington. And that's important to understand. I hear a lot of people say, I threw all my money in cash until the elections are over, and then I'll decide what to do with it. I think that's a risky and dangerous play. I think the markets tend to surprise us and have another market has a tendency to do the opposite of what we conventionally expected them to do. So our thought is it's going to be a bumpy ride for the rest of this year, no doubt. Stick to your long-term objectives. Stick to your plan. If you have a plan, look at the plan. How much money will you need and when will you need it, and how much of your portfolio is set aside in safer assets to cover that? We can move our entire portfolio so fast and so far over from one side to the other of risk. We can start timing the market, and it has been proven through multiple research papers of watching money movement from investors. Trying to time the market, especially with the whole kit and caboodle, is not a positive experience. And so the one thing we want to convey in this webinar is, look, things have been hard. We don't know. There's a lot of unpredictability happening for the next 3 to 6 months. Stick to your long-term plan. And I think in 2 years, in 4 years, in 5 years, you'll look back and be glad you did. So that's that. Maybe get off the stage there on that. But we obviously, we're here. If you have any questions you want, if you're already a client, thank you for being a client. We obviously welcome calls to sit and re-talk through any concerns you might have. But if you're not and you just want a second opinion, you want some just more perspective, we're always here to be willing to talk. So obviously reach out to us if you do want to discuss anything about your personal situation. But if you have an advisor, talk to them. Be active in communication so that when things maybe go awry again in the next 6 months, we don't make irrational, drastic, illogical decisions on our money. So with that, thanks again for being through my little longer than usual webinar. Appreciate the attention. If you do want a copy again of that full color booklet, or want us to put you on the list when we get those finally in the mail, give me an email, let me know. I'm happy to send those. There's my phone number. If you need to talk, give us a ring, and we're here to help. And again, thanks for your time.